What if you never had to sell anything and still had millions to spend every year? That is not a fantasy. It is a documented strategy used by some of the wealthiest people in the world. It has 3 steps: buy assets, borrow against them, die, and let heirs inherit with almost none of those gains ever taxed. This is called the buy, borrow, die strategy, and it is completely legal.
Bu videoda değilenler hiçbir halda investisiya tövsiyesi değil.
To understand why this strategy exists, you need to understand one simple rule about capital gains tax. A capital gain, the profit you make when an asset rises in value, is only taxed when you actually sell that asset, not while you hold it, not while it grows, only when you sell. In the United States, the long-term capital gains tax rate can be up to 23.8% for the highest earners. On a $10 billion holding, selling even a fraction triggers a tax bill measured in hundreds of millions of dollars. So wealthy investors looked for a way to access the value of their assets without ever triggering that sale. The answer was already sitting in the banking system. Banks and brokerage firms offer something called a securities-backed loan, a loan where your stocks or other investments serve as collateral. You do not sell the stocks, you simply pledge them. The bank lends you money at a relatively low interest rate because your collateral is extremely stable and valuable. As of the early 2020s, wealthy borrowers with large stock portfolios could access rates in the range of roughly 2 to 4% annually. Compare that to a long-term capital gains tax rate of up to 23.8%. The math already looks interesting. The documented use of this strategy at the very top of the wealth spectrum is well established. Here is how the borrowing step works in practice. Imagine someone holds $1 billion in stock. They have not sold a single share, so they owe 0 capital gains tax on those gains until a sale happens. They go to a bank or a brokerage firm's lending division and they pledge those shares as collateral. The bank evaluates the quality and stability of those shares. It then offers a loan, typically up to 50 or 60% of the portfolio's value. On a $1 billion portfolio, that is potentially $500 million in borrowing capacity. The interest rate on that loan is low, historically in the low single digits for large, well-collateralized borrowers. Let us say the rate is 3% annually. On a $50 million loan, that is $1.5 million per year in interest. Meanwhile, if the underlying stock grows at the historical average of the S&P 500, roughly 10% annually over long periods, the portfolio may gain $100 million that same year. The growth of the asset, still untaxed, vastly outpaces the cost of the loan. But here is what makes the borrowed money itself tax-free. Loan proceeds are not income. Under the United States tax code, money you borrow is not considered income. It is a liability, a debt you owe back. So the billionaire uses loan proceeds to pay for a private home, travel, or other personal expenses. None of that spending triggers income tax. They do pay interest on the loan, but that interest is often far smaller than what capital gains tax would have been. The loan is typically paid off in one of 2 ways. First, sell a small portion of shares to cover the interest or principal, paying tax only on that small sold fraction. Second, roll the loan into a new loan, kicking the repayment further down the road. This rolling process can continue for decades or until death when the estate settles the loan. Here is the part that financial headlines often leave out. Buy, borrow, die works with remarkable efficiency at the billionaire scale. But that efficiency depends on 3 conditions that most people simply do not have. First, the loan interest rate. The low rates available to billionaires, sometimes under 2%, are reserved for borrowers with enormous, diversified, highly liquid portfolios. A smaller investor borrowing against a modest stock portfolio typically pays significantly higher rates. At 8% interest, the cost of borrowing can exceed the after-tax gain from simply selling. Second, collateral risk. Specifically, what happens when stock prices fall? When the value of your collateral drops below a certain threshold, Called a maintenance requirement, the bank issues what is known as a margin call. A margin call means the bank demands you either add more collateral or repay part of the loan immediately. If you cannot, the bank sells your shares, possibly at exactly the wrong moment. During the 2022 market downturn, several tech founders who had borrowed heavily against company shares faced exactly this kind of pressure. This is a real and documented risk, not a theoretical one. Third, concentration risk. Most billionaires who use this strategy hold large concentrated positions in a single company, often one they founded. A concentrated position can grow spectacularly, but it can also collapse spectacularly. History records many cases of founders who borrowed against their equity and then watched the company's value fall sharply. When the collateral shrinks, the loan does not shrink with it. There is also the survivorship bias in how this strategy is reported. The stories you read about are the ones where it worked, where the asset kept growing, the loan stayed manageable, and the wealth passed smoothly to the next generation. Buy, borrow. Die is not a get-rich scheme. It is a description of how the tax code interacts with extreme concentrations of wealth held in appreciating assets over very long time horizons. The three steps only work smoothly together when the asset keeps growing, the loan stays manageable, and the estate is large enough to absorb whatever tax obligations remain. Remove any one of those conditions, and the strategy becomes significantly more complicated, or fails entirely. What this strategy does reveal, very clearly, is the central logic of how generational wealth is preserved. It is not about earning more. It is about never triggering the taxable event in the first place. The difference between wealth that grows and wealth that transfers is almost entirely in the timing and structure of when and whether assets are ever sold. That insight goes well beyond one three-step strategy. That understanding is what this channel is for.